Hello, everyone. Let's have a great NFP day. Should be no problem. No F problem. We'll see what kind of number we get. I'm showing the guests we're going to have today. We want to stick around for David Johnson. Someone referred him to me, and he has some great charts to talk about Fed action and what we're seeing right now as far as economic growth slowing. Actually began 2 years ago with the taper and the long lags you have in monetary policy. So should be a great interview. I've watched one of his other ones, and guy's very knowledgeable about money velocity. He'll also address what's happened in the repo market, Fed funds market. So stick around for that. Euro's trying to come out of here. Decent week in Euro, negative week so far in the Dixie. But, with the NFP, if we get better than expected, maybe we'll get another shot up. But if we didn't have NFP today, I think you could safely say that we're having a reversal week. And although we're having a reversal week, we're still above the close from 2 weeks ago. 98.46 was the close we had a couple weeks ago. So quite a ways away. Euro as well, even though it's having a nice week. If you see this, if you count back 2 candles, the close was 110.18, not far away from that, a weak number, and we could have it. And as you can see, this is a real short-term wedge line. We start penetrating this, I think you could be looking about 111 at least, maybe 111 and a half, but everything's going to boil down to the NFP. A lot of people think now they're going to get a rally to sell the market back at resistance. Look at the confluence here in S&Ps of the 2 moving averages on the 4-hour. They come in at 29.51. Maybe we pull back and go again. If you miss this, is the market going to accommodate? You already had almost 70 handle rally from yesterday's low. So this was another lesson that you don't know if you have a breakdown unless you close underneath a breakdown level, which the S&Ps did not. I sure thought they were going to. And when Steve and I were talking, he said plunge protection teams at work, and I saw this candle. I said there's pretty good divergence, but it's only a second drive, but great recovery. I don't know if it was PPT. I don't know if I believe in that or not. Could be. Nothing surprises me anymore. Yen had a negative week, starting to enter into an area that might be interesting down here around the 106 level. This could just be an ABC, and we could start to go higher again if risk comes back. And I think that's about all I have so far this morning. Looking forward to the interview with David. I hope everyone had a good week. How are you, Monica and Paul and Zolt? How are you? Shahab? What's everyone's guess for the NFP today? Strong or weak number? Put it in chat. Strong or weak? Zolt says weak.
Yeah, the big question here, Coach, is when are we going to actually find out if it was strong or weak?
Oh, yeah, because of revisions, Steve?
Yeah, because I remind you that we ended up revising down 500,000 jobs for a year. And, everybody was celebrating good numbers or okay numbers. And then 1 year later, something, none of that was great. It was like on average 43,000 less per month. So,
Yeah, and we criticized China for being opaque. Isn't that ironic? Huh?
To be fair, there's no comparison.
All right.
No comparison. Not yet, at least.
Yeah. So what are you looking for this number, Steve, that will be corrected after it comes out down the road? Huh?
Something guesswork is,
doesn't matter.
is not what we do. Of course, with the data we've been seeing for every month that passes, the chances of a weak number are increasing. There's no question about it, right?
Yeah.
Now, the only thing that we have to worry about is what do we think the market is going to do in, scenario A, and what do we think the market is going to do in scenario B? Because, assuming in advance what of the two is going to happen, I don't think it makes any sense.
Well, in a bull market, it wouldn't matter. Strong numbers the market would like, and a weak number, they'd say the Fed has their back. So I think it's going to be interesting, no matter what the number is the reaction to it.
I think the market has already started worrying about the slowdown.
That's what I mean.
And I think that a bad number is not going to be easy to swallow.
You think the PPT was in yesterday? You believe in that, don't you?
Who knows? Who knows?
Oh, okay.
Who knows?
Maybe you were joking.
No, it's like half joking. You know what I mean? Who knows?
Yeah.
Really, who knows? I mean,
I don't even like the myth when I'm short. Anyway,
let's see what Blake thinks.
Yeah, what are you thinking in here, Blake?
Sorry, I was just looking for the mute. I was just looking for the unmute button, making sure I wasn't clicking the office. Yes. Well, yesterday was it yesterday?
Yeah.
It was yesterday. I clicked the wrong button, and I was talking to you guys, and everybody in my office is like, "Hey, turn it off," because I keep it on mute because it's annoying to them, because at the office I sound like I just come over the loudspeaker. So here I am, just everybody's like, "Shut up," and I'm talking to you guys. And anyway, but yeah, I had to make sure I hit the right button. So good morning, guys.
Good morning, Blake.
I just tweeted something, and I'm going to show it to you really quick. This is from Grega. You guys know Grega is obviously our Elliott Wave guru, who actually he's going to be filming the week ahead video. Just a little, giving you guys a little insight about this weekend.
He watches everything, doesn't he?
I'm sorry.
He watches everything.
He does. Well, this is actually pretty interesting. I have mixed opinions about this, so I want to clarify what is being displayed to you guys at this moment. So Grega, he goes, "Hey, just FYI, the ISM. This is the ISM services, by the way. So every time this year the ISM services number has been good or bad, NFP has come in opposite. Now that would imply that we're going to have a strong number today and beat expectations that come in around I guess it's 130. Let me double check. Now 140 is what the 145 is what that market's looking for. That's Forex Factory. Bloomberg's looking for 145. So yeah, it's 145,000. JP Morgan, just so you guys know, their model spit out 127. I think the whisper number is probably closer to 125. So and obviously that's just the headline number. That's not taking into account what wages come in as and all the other small components inside of the data. But we're just talking about the headline number here. I don't necessarily think that the headline number is going to be a better read. I actually believe, and this is just going back to your original question, that that the data this month has actually turned decisively worse. And we talked about that at the beginning of the week. You remember, Coach, we were talking about how employment data is going to start to weaken, and it did. I mean, well, let me take that back. The data that we're seeing is starting to show some weakness. However, there's always that risk that the number comes in better than expected. I don't think it's going to. I just think it's not going to be as bad as the market is expecting right now. And I think everybody's expecting like some really poor numbers, right? You can see that in the, I guess the best way to see it is in the dollar yen. The dollar yen has broken down through the 107 level. And I think everybody's now really anticipating that this number is going to be a weak weak number, which it very well could be. I just don't. I think that maybe it won't be as bad as everybody thinks. So that's my opinion.
Okay. Yeah. So yeah, you were talking about weakness early in the week. So what do you think if we get a weak number, dollar weakness could continue and kind of seal the turn and get a breakout in euro and things like that, Blake?
Yeah, I think so. And you know, the euro dollar. So the things that are on my radar, and it's I'm long euro. I'm long New Zealand yen. So that's like my. And if you guys don't know why my positioning is here, I'm going out of town next week. And I'm going to be out of town towards the end of next week. So I'm trying to position myself ahead of the China-U.S. trade summit. So and my 2 cents is about that is that, you know, China and the U.S. are going to have to come to some sort of agreement, and it's mostly because of Trump. I think Trump's he's gonna blink, and he's gonna you know, cave in a little bit. And offer up something to China. That's what I think is going to happen. I may be wrong, but you know, that's how I'm trying to position myself. So that's why I'm long the New Zealand yen. And I've been talking about, even yesterday, I talked about the divergences of the S&P versus the yen pairs, and the S&P hit new lows and then reversed yesterday. And so, you know, I was more or less playing because the yen pairs actually are holding up relatively well. But the New Zealand yen, I don't know if is going to be a huge factor in today's data, but it might be more influenced by the yen, which is going to be the most heavily influenced, I think, by the data. And so I think that if the data comes in stronger than expected, so let me say this: if the data comes in stronger than expected, I think the dollar yen is going to squeeze back above 107 because everybody's short now. You can see we got this double top. It's breaking down. We're consolidating below 107. We get a good number, and this is going to happen. See this? This is happening, right? We're gonna see a, you know, move right back up to 108, and I think this is where the squeeze happens. This is the trade that I'd prefer actually a good number. I'd prefer a good number or a not so bad number, because I think this is where the market gets caught wrong-footed. You know, they're short, they're going to get squeezed. We'll squeeze up to, you know, 107.50, maybe even higher than that. That's kind of what I hope happens. And it's because I don't think it's going to, it'll probably have a more positive impact on my New Zealand yen. So, but I'm not trying to talk from a biased point of view. I'm trying to talk from a what I think is going to be the best trade. So now let's flip the script a little bit, and let's say that it's a weaker number. If it's a weaker number, then I think that you know what you just mentioned, Dale, is really probably what's going to happen here. Is we're going to see a move above, you know, the 110 level in the euro dollar, and we're really going to start squeezing. But it's not just the euro that's squeezing. I mean, look at the Kiwi is, you know, I put this on the chart of the day yesterday, was the Kiwi dollar and the squeeze in the Kiwi. Big divergence on the daily charts. The Aussie dollar is squeezing here. The US dollar Canadian's finally starting to show some weakness. Where's the Swissy? Swissy rolled over hard last night. Another failure, third failure above parity, third day above parity. So this is a triple tweezer top. I don't even know if that's a thing, but it seems like it's a thing. We had a nice roll over there. So I think that if we have weak data, the market's already positioned for it, but I think the market will play it. But if we have a stronger than expected data, then it's the dollar yen that's really going to be the trade here. So I mean, I'm trying to come in without a bias, even though I'm long, you know, New Zealand yen here. At least, excuse me, that's my core position is long New Zealand yen. But I think that that it can be played either way, and that's the good news about today is a good data, bad data, you have plenty of opportunities here. So
Hey Blake, when I had David on from Aspen Trading, he liked CAD yen. Is it a Kiwi yen and CAD yen kind of similar? They travel in similar directions.
yeah, now was he bullish CAD yen?
Yeah, he was early, but he was constructive because he thought there was, risk on was going to work.
Well, it hasn't the last couple of
Yeah,
days. We saw a
right.
really big sell off. Now, yesterday, if you were in the chat room
Yeah.
and you were using ForexAnalytix, I got long, and I know a few of us got long the Canadian yen right here on this Gartley pattern. It was a perfect Gartley at 79.80, and I was just going to get long this morning too at 80.10, and I took my eyes off it because I was updating charts on ForexAnalytix, and it actually this happened over the last hour.
Oh, nice.
Well, yeah, I was gonna buy it, and then like I said, I took my eyes off, and I look over, and it's already kind of ripped off of that base. But I think the Canadian yen and the New Zealand yen will move the same. But the Canadian yen, we have been, and I say we as in everybody in the ForexAnalytix chat room has really been focused on this downtrend line. I know Chi, who's he's in our chat room all the time. We've been in the same chat room, I think, probably for the last 6 or 7 years. He was trading the failure up here. The last couple of weeks, every time we get up to this trend line, he was shorting it. So I think if it gets above 81, well, let's just call it 82 yen. It gets above 82 yen. It's extremely bullish, but there's a lot of room between here and there.
Yeah.
Do you remember, Coach? We don't have it here now. Well, maybe we do. And do they do limit up anymore?
You mean
In anything?
in futures?
Yeah, I mean, do we get?
I think they do still have limits.
Do they really?
Mm-hmm.
Okay, it's been so long since we've seen like a limit up move,
Yeah.
But put together a China-U.S. trade deal, we'll probably get like limit up and
Right.
but then you would expect like the Canadian yen would rip right through this 82 yen level, and that's what I'm kind of hoping. Well,
that's what he was thinking.
Yeah. I say kind of hoping. I'm really hoping we get some sort of like major breakthrough in China-U.S. trade deal, and we get some limit up action, and New Zealand yen, Aussie yen, Canadian yen. I mean, they'll all be trading, depending on the nature of the move, 100, 200 pips higher, I would think. So.
Good. Thank you, bro.
Yeah. So anyway, but when was Dave on? From
Dave
Aspen. Was it from Aspen Trading?
Yeah, I forgot Dave's last name again.
But when was it? Do you remember when he was on?
Yeah, I think not the exact day, but I remember looking at it and said I thought there could be one more dip, and here we are.
Oh, okay.
So,
yeah. And and then this is the and I tweeted this yesterday. As long as this holds, yes, it was risk off exactly from yesterday. And then I'm like, when I tweeted that here, I'm like, if this holds, this is a Gartley pattern. It's bullish. And I traded it long yesterday. I got out of it at 80.15, 80.17, and I bought it at 80.80. So I literally cherry picked the bottom. I mean, maybe it was like 80.82 or something. I literally happened to be right in front of the computer drawing this out, going, oh, that's it, that's the bottom, and then I went long. But I'm not long anymore. I kind of wish I was, but maybe after NFP I won't wish I was long. Maybe after NFP I'll be like, glad I didn't take that long. And I guess we're going to find out here in the next 10 minutes. But so those are the setups that I'm looking at moving into this next week, is just, or next week, in the next next 20 minutes or so, is just, like I said, I think the dollar's got really good opportunities either way. But if the number is good, I would assume that the yen pairs move higher. That would be my gut instinct, that you see the dollar yen break back above 107, the euro yen, you can see this nice, and actually I could probably do a little bit of drawing here for you guys. This looks like a bit of a descending wedge, like in the euro yen. So that looks pretty constructive if it reversed, right? If we got a reversal, it'd look pretty bullish here. And you know, this is seems like a really slow, you know, just descending wedge. It looks like it's going to reverse. Pound yen I leave alone because of the Brexit situation. Aussie yen had a nice pullback to confluence, big confluence at the 618, 78% retracement, 78% retracement of this move, 618 of the spike low down here. And then the Canadian yen obviously looks like, I think the Canadian yen looks like it's going back above 80.50 today. So, you know, these yen pairs look great. If we have a favorable number, and if it's a weak number, then you just look at the dollar pairs that have been running. I mean, you know, the euro looks like it's going back to 110.50, and you know, the Aussie and the Kiwi look like they're in recovery mode. So anyway, that's how I feel about today. It's pretty simple. If you guys want to know, I think how you know, if you want like a really good confirmation, just look at gold, right? I mean, you look at gold and see how gold responds here. You know, if gold is strengthening, that's a bet that the dollar is weakening. So if gold breaks out higher, then you have to imagine that the dollar is weakening significantly, and the dollar yen's probably falling. And then if gold sells off, then that's a pretty good indication that the dollar is going to rip. So so that's it. Steve, good morning. I heard you earlier.
Good morning, Blake.
How's it going? So, hey, Stelios is here too.
Hey.
Good morning, guys. So what are you guys' thoughts ahead of today? And you saw this chart from Grega. How do you feel about this?
Yeah, I personally think it's probably a little bit of a coincidence.
Me too.
I mean,
that would have been that's my gut feeling. It's a coincidence, and you know, we're obviously seeing the data weaken decisively this month, right?
yeah.
Okay.
We've had data weakening for at least a year, but the initial weakening part was extremely slow. So, you know, only by plotting the data, you would realize that there was a little bit of a slowdown. But yes, it seems to have accelerated.
Yeah, it does. Now we had a you know, the S&P I feel really you know, caught some support yesterday, and you know, obviously the analysis on ForexAnalytix, you're pretty well aware as of actually going back to October 2nd. It says, you know, we broke decisively lower today and the 200-day moving average is in view. However, the 618 retracement of the August lows to highs is at 28.63, and the 24% retracement of the 2018 lows to highs comes in at the same place. So bears should take note. And that support really held yesterday. That we pushed below that. We got a hammer yesterday. Bears were probably a little shell shocked in that move. And you know, a good number maybe puts us back up at resistance here at 29.40. So it's a little bit of a difficult read with the S&P here. I tried to make a point yesterday on Twitter that we're still making higher lows, and you know,
we are indeed.
Yeah, so as long as we continue to make these higher lows, it's hard for me to get real bearish.
Personally, Blake, I think that a rebound to the 29.40 to 29.60, because both those levels are, you know, important resistances area.
Yeah,
is going to be an amazing shorting opportunity. My personal point of view from a technical perspective.
yeah. I mean, yeah, I would agree. You know, I look at technically, and you know, we look at those highs of basically being the same. It's like, are we developing some sort of wedge here? You know, so it's like, yeah, again, I'm a little nervous about being short equities ahead of next week. I mean, you know, I think Trump is desperate. So that's my whole basis of thinking the way that I'm thinking, is I think he's desperate at this point. So, you know, the risk of a deal is you know, I think higher. Anyway, but just my 2 cents.
He
Still-
doesn't drink alcohol. He needs a shot of tequila
Man, he's
to relax.
chillax. You would think by the way he tweets and what he tweets sometimes that
he doesn't drink.
No, you'd think he does drink. I would think that guy was like, I mean, half the time, like, man, that guy hitting the.
You mean like one of those mad or mean drunks?
Yeah,
you know,
like a
people that get
tequila
pissed
drunk.
off.
Yeah, it's a
All right.
tequila drunk. You've been
No,
there,
yeah,
right, Dale? Come on,
yeah. My worst hangover ever. But yeah,
really?
He's there without it.
I know.
Anyway,
Hey, I know what happens in California. It's the sombrero, the guy with the sombrero and the whistle in Tijuana, and that crappy tequila, whistling, pulling your head back. You know. Yeah. You've been there. Don't tell me you haven't. You can't lie to me.
I stumbled across the border.
Yes, you can act like you're all. You know, it's everybody's been to Tijuana if you live in San Diego.
Oh, I have many skeletons, Blake. Anyway, more than you'll see Halloween. So. All right.
Okay. So anyway, I'm gonna be leaving
Blake,
you guys here. Just
by the way,
yeah.
May I take the opportunity to say that what you were showing that people, you know, could have read or whatever, they could even do that if they had access to our light plan. So, you know, to people that might have not taken the opportunity because, you know, they can't afford the price or whatever, we also have the light plan, which gives them access to quite a few of the things we do, right?
That's correct. If you guys, so if you don't know, we have just our regular ForexAnalytix, but we also have a light version. It's only $19 per month. And if you guys didn't see this is something that we released the last couple of weeks. Yeah, you don't get the patterns in play and some of the advanced analysis, but all the basic technical analysis that I put up, Amanda, Paul Franco, Steve, you get the macro analysis that Stelios does. He only does macro analysis once every 4 or 5 months. I'm joking, Stelios. I'm totally joking. Just giving you a hard time. That was from that one guy. Remember that was inside joke. Anyway, but yeah, if you guys want the analysis that is provided in the basic or candlestick or macro, go get the light plan. It's only $19 a month. It's and you get all these cool little tools and stuff. And anyway, oh crap, I just lost everything.
What's the tagline for light?
God, what is it, Dale? You know,
Forex. Go ahead. Stel knows it. You do it, man.
Actually, I know the second part. No, you say it, Dale. You say it.
ForexAnalytix says, "Let there be light."
There it is. So good. All right. Hey guys, I'm gonna let you go. Good luck today, and good luck for non-farm payroll, and I'll see you guys on I won't see you on the week ahead video. Greg is gonna do it, but I'll see you on Monday. I'll be here on Monday.
Thank you, Blake.
Have a good
Thanks,
weekend.
guys. Hey, have a great weekend, TGIF, and appreciate all you guys.
Thank you, Blake. I think Steve is rebooting his Mac, so it's you and me for now, Dale.
Okay.
What I wanted to say, we have a minute and a bit to go. What I wanted to say is I've been trying to get my head around equities for some time now, and I think it seems to me there's been a pretty significant change recently. You know, over the since the global financial crisis, it used to be good data, stocks go up, bad data, stocks go down. It was quite simple. Then with QE and zero rates, it was the opposite. Eventually, you know, since 2010, 2011, the rallies. Every time we had bad numbers, the market just rallied because they all thought, okay, rates are not going up. Borrowing's going to be cheap. Companies issue bonds. They're going to use the proceeds to do buybacks. Easy. Now, what we're seeing in the last few prints is that you get some bad numbers, and the initial reaction is down. Now, yesterday we did see a squeeze, but that was probably
okay, good.
We can hear you. That was probably just a short squeeze because the market's been quite short. If you saw the stocks that rallied, they were the shorted ones, the really, really shorted ones. The big ones like Amazon and Apple and all that. They were much more. They were much more flat. But
data
anyway,
in 15 seconds.
Yes. I'm going to write a blog over the weekend. Probably publish it on Monday about stocks. So stay tuned for that. Okay, numbers.
Interesting. Yeah, we have a different regime now.
Maybe, I don't know. Okay. 136, is it?
Yeah, it
Yes.
did.
So the JP
And
Morgan
expected.
was spot on, right? Well done to those
Yeah,
guys.
they
same here.
were really spot on. It's not that bad. It's not that bad.
Unemployment rate
Look at the unemployment rate. That
went down. Participation is flat, so that's really good. That's really good.
wait a
actually.
second. How is that possible? How can we get 0.2% off in unemployment with payrolls not being that good and participation staying flat?
Good question.
Because they're
Well-
rigged. Okay, I gotta go, guys. See ya. Bye.
Yeah. The
Bye, Blake.
revision from 130 was 168. So a good revision there. You got 30K more, but still doesn't justify it. So
Yeah, still, I mean, it's quite a big drop for.
market
Anyhow,
actually
let's see.
not
The
doing-
market, I think, is
yeah.
more or less confused. It doesn't really know what to do with this data.
Yes.
Dollar seems to be strengthening to begin with, but not substantially.
Precious metals are really the ones I always look at for their direction, and they've done nothing. So because they tend to go wild on these numbers.
S&Ps are performing the best of the group.
Yeah, S&Ps are up. Wow, yeah, 10 points, 10, 15 points. Is that right?
Yeah, 11,
Yeah.
12, yeah.
Wow.
Yeah,
Okay.
S&P is recovering from here, so one more leg higher as it seems. USD yen is seems to be holding. If you see on the bottom right, the retest of this broken. We talked about this a couple of days ago, if I remember right. We found support in this descending channels resistance trend line once, and we dipped down to retest it a second time. So, for the time being, this seems to be holding a support. So as long as it does, the scenario Blake was talking about, that perhaps, we might have another move higher in the USD yen is not unlikely. Euro USD is weakening after more or less retesting yesterday's highs. Speaking about the cable, I was talking about the importance yesterday of seeing if cable is going to manage to close above 123.70, 123.80. At some point, it was trading even above 124, but it pared back its gains to close below it. So, as long as we are holding at that resistance area, there is a decent chance that we're going to see more weakness. As it seems in general, the reaction seems to be a slow grind higher in the dollar and risk. So that's what we're seeing so far, at least. Let's see what the Aussie and the Kiwi are doing against the dollar. Let's see. So Aussie weakening a little bit as well, and the Kiwi, yeah, same deal, weakening a little bit. Anyhow, still positive on the day, both of those. The euro, on the other hand, is back to almost unchanged. Keep in mind that we've been saying that again and again, having to do with the euro USD, since it's one of the most popular, obviously, tickers out there and the most liquid currency pair. I was monitoring at this descending trend line resistance because we might have been finding support in this descending, the larger descending wedges trend line support, but in order for us to put in place some type of a bullish breakout, at least a small one, we would need to pass through this descending trend line. So we didn't even make it there. And as we speak, Euro USD is unchanged for the day, which of course, makes it the high risk that we're going to fail once again, right? I mean, we have been seeing a series of lower highs, and if we stall here, it's going to be more or less one and the same. Now, USD Swiss pared back most of its earlier losses, but keep in mind, Blake showed that as well. It's not only the fact that it remains.
By the way, metals just crashed.
Yeah,
anyway,
no big
on.
surprise. Let's see. So USD Swiss, 3 days in a row finding resistance at the confluence of the 61.8 and parity, which is a horizontal support area, also a big psychological level, obviously. Now crashed, I don't know if it would be the word I would be using yet, Stelio, but yeah, I mean they've gone negative on the day. I mean, here is gold. And let's have a look at what silver is doing. There we go. And silver is actually, silver is a
Weaker.
lot lower. Yeah,
the
it's
gold silver ratio is heading up, Steve.
It is. Let's have a look at it since you mentioned it. Here it is. Yes, it is pushing higher. Keep in mind, as we've said, keep an eye on the 61.8% fib from this move lower, having to do with the gold silver ratio. That comes at 88. I think that 88 might produce some nice resistance. Also, I haven't drawn it, but I'm fully aware that there is a horizontal support resistance area here, and you can see it very easily. Once I draw it, you can see why. Right, there it is. So 61.8 and horizontal support resistance area, passing from there. And as it seems, we are probably headed to that level. The one that's actually crashing more than anything is platinum. Platinum, after putting in place that huge rejection from the long-term trend line, moved lower, accelerating, and currently testing. Actually, this is like the third in 4 days that it's testing this 875 level. I have to admit that it looks very weak, and I kind of doubt it that we're going to manage to penetrate through it. Now, what is actually doing well here is crude. I mentioned yesterday that you should be careful because we are approaching the 50.5 support area, which is a significant area. So you shouldn't you shouldn't try to press your luck there, because it would be very likely that it would produce some kind of a reaction. We didn't exactly make it there. I mean, we made it to 51, and now we're seeing a nice recovery. Yesterday's candle, first of all, that ended up being like a hammer, albeit black in color, still a hammer. And today we seem to be well bid since the day opened. And if risk keeps overperforming during the day, probably crude is going to continue higher. Now, I would assume that 54.50 to 55, which was previous support, would act as resistance. But until we make it there, I mean, we have another $1.50 to $2. So there is still potentially a decent upside, even if this is purely a corrective move. Now, if we want to go back and have a look at what's happening here with risk on the 4-hour chart, my assumption would be, okay, sorry, everything is going really slow on a MacBook when you connect so many screens, etc. But I'm still not on my main computer. So I would assume that something like this might happen from here.
Yeah.
Since we found a low yesterday. So I would assume that there's going to be more weakness, but from higher levels, right? 29.40, 29.60, both of them important resistances. So
maybe Blake is right, and they put together, at least say they have a deal, and that's what generates that rally next week.
Let's see. So these are the two areas I would be looking for, right? Mm-hmm. I think that with the data being what they are, and unless the Fed in October's meeting doesn't over-deliver, because the market is already fully pricing in a 25 base points cut, I'm pretty sure that unless we get either more from the Fed than the market expecting, or as Blake mentioned, some kind of capitulation from Trump and producing a deal that will take off tariffs, etc. I'm assuming that 29.40 to 29.60 is going to be a very, very hard resistance to crack. So personally, I'm going to be looking, to press with short positions there.
Is the Fed next week, Steve, or it's a few weeks, isn't it? The Fed meeting in October?
I'm not sure about the date. We have to check it, actually. Stelio, are you still here?
No, just you and me.
October 30th. Yeah, I remember it was close to the end of the month, but I didn't remember the date. Yeah.
Yeah. Paul's going to say, boo. Scare us all.
Probably he's going to want to do the exact opposite of what you mentioned.
Yeah.
Yeah. So let's see what the VIX is doing. By the way, I mean we've had this pullback in the VIX, obviously. Actually, I haven't drawn much in the VIX on the 4-hour chart. I'm mostly doing the drawing on the daily, because it's worth monitoring on the longer term scale. Now, DAX remains also very, very weak, if you see. So it's not about only the S&P. And I have to be honest, the rebound higher in the DAX so far looks very, very corrective in nature. I mean, look at this. Found support at the 11,800. 11,800 has been for a long period of time a very key support resistance area, and it seems to be rebounding. But I have to say that so far this rebound doesn't look impulsive to me. I doubt we can easily make it above this previous support, previous low that might act as resistance at 12,140. So I would still be looking for more weakness. I mean, judging by the type of the move we had lower, I would expect that sooner or later this rebound in the DAX should fail, right? Perhaps it's a pennant, might be a flag, too early to say. Okay. We had some requests. Let me open the question box.
And just for your information, David is here. So anytime you want to wrap up, Steve, I know it's Friday.
Absolutely.
Up to you.
Absolutely. I'm just going to cover questions and see how the market is doing, and then yeah.
Okay.
And
I think you'll enjoy what David's going to present. He's right up your alley. Yeah.
Corn going up. Yeah, I'm going to try to stick around and listen to the interview. There was a German holiday yesterday. Okay. So let's see what how everything is performing. So far, the rebound in the risk seems to have stalled. And as it seems, the rebound in the dollar seems to have stalled as well. So we saw this initial reaction, but as the market is digesting the information, is probably rethinking how bullish the data was, because the nominal unemployment number doesn't really play that much of an importance. Today's NFP number confirms the weakness, the weakening employment data as they come out as well. We've already had manufacturing going in contraction. We already had a big stall in services. We've already had the horrific data coming out of the Eurozone the past few weeks. So I'm pretty sure that the market is rethinking the whole bullish argument just because the nominal unemployment fell. So we'll need to see how this turns out to be as a day. But so far, no follow through. USD yen holding still that support. So there's an argument to be made here that as long as we stay above 106.50, there is a decent risk reward ratio to try your luck being long USD yen. Personally, I'm not going to be doing that, just to be frank. Now everything else seems to have actually stalled. I think we need to give it more time and see how the market wants to react from here. We had a question before from Forex Gal, and I don't want to forget about it. Not for any other reason. I was showing that in the chat room. I think it was the day before yesterday. She asked about about the USD SEC, and I have to tell you that the USD SEC remains very well bid. I mean, the epitome of an uptrend, higher lows, and even higher highs, actually. But look at where we have stalled, right? I mean, we stalled once again exactly on this ascending trend line resistance from this long-term ascending wedge. Now, admittedly, it's been already like 3 consecutive days that we've been consolidating near the highs, and that is not bearish price action, right? So this confluence of resistance is because, you know, we also have the previous high there. We have, you know, a 141.4% extension. So there was a confluence of resistances. It, you know, it worked enough to, you know, to stall the acceleration higher, but on the other hand, you know, it doesn't look like it wants to start moving lower. I don't know. We need to wait a little bit more. Same deal here with USD NOK. I mean, USD NOK. Who knows what kind of information is this? Somebody can say that, you know, it is an ascending triangle, in which case there's still a very high possibility that we're going to eventually break higher and head towards channel resistance once again. Now, you know, in order for us to start thinking bearish case scenarios like a double top, we would need to see price dropping below 891, and then and only then that's going to be a double top, right? Until then, I'm just seeing a consolidation near the highs, so not really any bearish price action. And another one I wanted to cover is USD CAD, because USD CAD, you can see it here, you know, it had a very, very nice day higher the day before yesterday, on Wednesday, but keep in mind that it still remains stuck in this formation, while at the same time within a long-term ascending channel. So 133.50, confluence of the 61.8 of the last move lower, and, you know, this trend line resistance, very important, you know, resistance. I think that, you know, if bulls manage to push price above that level, we should see an extension towards the 135.65 area. We had the previous high there. Now, as long as we don't see that, there's still nothing to do here. Above 133.56, as I said, probably another 200 pips of upside. So not a bad trade altogether. Probably playing this breakout is not a bad idea from a trading perspective. Okay. I also like the fact, if we do see price action accelerating to the upside soon, that we've broken this descending trend line resistance in the RSI. So it doesn't look that bad as long as we make it above 133.56. Okay, especially, for example, if we manage to close the day and the week above that, probably quite a nice short-term bullish signal. No. Joseph is asking if I'm still shorting the USD NOK. No, I made an attempt to do so when it started correcting lower, and that was it. I mean, not in any case. I mean, I thought that the correction lower would be, you know, bigger than what we had. But, you know, once that wasn't the case, there is no bearish argument to be made here with USD NOK. As I was just telling you, it looks like it's consolidating before moving higher. So absolutely not. I'm not looking to I mean, I would only consider it below 891, as I told you. Above 891, I don't see anything that isn't bullish in USD NOK. Euro has turned a little bit negative on the day, by the way, but at the same time, S&P is unchanged on the day. So off the highs once again, dollar moving higher, but S&P can't follow, because initially we saw that reaction, which was positive risk, positive dollar, but now we, as it seems, we still have a positive dollar market reaction, but risk has stalled. As you see, there is a danger here that cable is going to be rejected from 123.70 once again. I mean, cable moving lower. Yesterday's inability of the pair to close above 123.70 was telling, in my opinion. And if we have a look at the DXY, I'm still very, very uncertain about what kind of recovery we have here. I mean, I don't like it long from what I'm seeing, but we still haven't invalidated the basic uptrend, right? As I was saying the other day, I'm looking for this intermittent ascending red trend line support. If we broke below it, I would really want to start pressing on US dollar shorts. But we haven't done that yet, right? So you need to respect this slow updrift in the dollar until proven otherwise. Coach, I
Yes.
think I covered the things I wanted to do. So
Just
so you can go
one
ahead.
more quick thing from Coach. Your take on treasuries. I mean, there was a little flight to quality the other day.
Oh yeah,
We have a
treasuries are
low.
almost at the highs.
Yeah. So what do you think? New highs first?
You know something? Let's first have a look at the bonds,
Okay.
because you will
Yeah, they're
see that
weaker.
there is a telling divergence here, right? A
Yeah.
very telling divergence here. So the
Well, they led
rebound
the
in,
way up. Maybe they'll lead the way down.
yeah, the rebound in in the bonds still looks corrective, as
Right.
initially the rebound in treasuries was looking corrective. But look at
Yeah.
this. I
Yeah.
mean, we had an acceleration higher. Intraday, we saw this attempt to turn lower, but it was just intraday, because then we closed the day, leaving behind like a long outside hammer, and now we're almost at the highs again. So can they stall from where we currently are? Yeah, they can, but I don't like this move higher. I mean, I don't like that we've retraced so much. Of course, there can always
88% or something.
yeah, we're exactly
Almost
at the. I've drawn it on the 4-hour chart, and yes, we have stalled exactly at the 88.6% fib.
The
That's
bonds
exactly
look
right.
like the better short on strength
Oh,
than US. I wonder why that's happening. Why they look weaker than, because they might be closer to being done with an easing cycle, or what? Why are they why are they weaker all of a sudden than US Treasuries?
Now, if you want to put that on expectations of monetary policy, one thing I can tell you in comparison is that there is more willingness and more risk, I mean, higher risk, that the US is going to press more on monetary policy in the months ahead.
Okay.
We know that the ECB has already more or less used everything they could having to do with interest rates. I mean, there is a big conversation of if there is any point doing anything in interest rates from where they are. I mean, deposit facilities at minus 0.5, everything is at 0%. They've already announced, so it's like, by the rumors and the fact that QE is going to be restarting. So what else? What else is left there?
Anyway, technically, you noticed that shift while it was happening. And I was just interested in, what fundamentally could be driving what is a different story now than 2 months ago.
Definitely, one thing for sure is that the market has started week by week expecting more from the Fed than it was. I want to remind you that just a few weeks ago, Powell said the following, that this is, I mean, I can't even say it without laughing, but I'm going to make an attempt. This is a mid-cycle adjustment. So according to Powell, just by translating a single sentence, we are mid-cycle, which would roughly mean that Powell thinks that this is not only going to be the longest business cycle we've ever had in history, which
we're only in the middle of it. It'll be a 20-year.
But we're only in the middle, which means that this is going to be a business cycle that's going to be more than twice as long as the second biggest cycle we've had in history. Because, of course, the world economy is so great. I mean, there is no debt. We've solved all the problems. There are no unfunded liabilities. Productivity is doing wonders and all the rest. So he was saying that this is a mid-cycle adjustment. And I want to remind you that currently the market is pricing in an absolute certainty that we're going to get a third consecutive rate cut. Sorry.
Yeah.
So, you be the judge if this is a mid-cycle adjustment or, the beginning of the end. You know my opinion. I've been saying it since last, whatever it was, October, November.
Well, instead of it being mid-cycle, if our president had his way, Jerome Powell would be on a buy cycle, pedaling away from the Fed. So anyway,
You know something, and that has nothing to do with my opinion about Trump or Powell or whatever. He should have been more careful. I mean, he has nobody else to blame. Is Powell bad at his job? He's horrible at his job, as Yellen was horrible at her job, as Bernanke is horrible at his job, because simply the Fed is doing bad to the economy instead of good. But you know, Trump selected Powell specifically, so you know he has to live with that. Either he likes him or he doesn't. It's his own choice. And you know, in life, one of the first things that you know your parents teach you is that you have to live with the repercussions of your mistakes.
Yeah, and thank you for hanging in there with me. So you have a great weekend, buddy.
You too, Coach.
Nice review. David, welcome to Face for the first time. I'm going to promote you. Probably, you know, traders don't get a lot of promotions, but unless we self-promote. So I'm promoting you to panelist. And now I'm going to unmute you. And look forward to meeting you and having a conversation. Welcome to Face, David.
Good morning.
Good morning, buddy. Nice to meet you.
Nice to meet you.
If you do want to share your screen, you'll see a green box, probably at the top of your screen.
Share?
You share. That's it.
Okay, I'm just going to share my entire, so they see my desktop and everything.
There we go.
Does it work?
Yep. We have the Zoom page up.
I've just lost the page. I just lost the display. Oh, so I don't have a display.
You just hover your mouse around it.
I
If
am
you
the
hover
screen.
your mouse at the top,
Yeah.
you should get you should get a pop down. We can't see it because you know Zoom doesn't share those panels with viewers.
Okay, so basically my screen is the screen.
We
Right.
can see your browser and the window
Yeah.
and the tab.
What
you
is
use
the
to launch
quantity? If you click that, quantity theory of money, it's
Yeah.
just you're not showing one of your browsers where you have that.
Yeah.
So you could unshare and then pick the screen you want to.
Yeah, you can
Is
change
there a
it.
Zoom screen for me?
No, there isn't.
There's no Zoom screen. I just am the screen.
You are the screen. That is
Yeah.
very correct. Yes. As long as you're sharing, there is no screen for you to see.
Very good. And then when I still stop share, then I'll get back the previous
Yeah.
full Zoom.
Yeah.
All right.
So we can see your desktop. We can see the folder you just opened.
Yeah. Just like the NSA.
Absolutely.
How's that coffee?
It's my first one. It's excellent.
All right. Okay. Yeah, you're an early riser too. You're up in Vancouver, right? So
Yeah.
Pacific time.
Pacific.
Okay.
Time. Have you seen that?
We have S&P up here now, David.
What do you think of that? Excitement about interest rate cuts.
Yeah.
As always, the Fed is very late to respond to the mess the Fed is doing on its own. Yeah.
Yeah. So that's the last 23 cuts were all during precipitous drops of the stock market.
And one could be beginning here. And David, I listened to your interview that you had with, I forgot his name at TF Metals. I've interviewed him before.
Craig Hemke.
Very sharp guy. And it was a great interview. And the gist I got out of it is whatever the Fed is doing, there's normally about a 2-year lag time.
Yeah, 2 to 3. Yeah.
Okay, and we're at about the 2.5-year mark from QT.
2 3/4.
Started.
But yeah, it's September. It started first quarter of 2017.
Okay.
Yeah.
So you think we're in the middle of a credit cycle implosion? Is that correct?
Yeah, they've constricted the money supply now, and it's termination of the credit bubble.
Okay.
Credit cycle, they like to call it, but it's a credit bubble.
Okay. Do you want to show? We lost your S&P chart.
Yeah, I've just got a few charts here.
Okay, that's fine.
So if I just go here, like I'll just maybe talk orally just about the concept of money and money supply,
Okay. But have
quantity.
a chart up there too, besides that
Yeah,
Zoom screen. So I saw the charts that you used with Craig.
yeah. I'll use just the same ones here.
Okay.
So I just start with the quantity theory of money, which all economists, almost all of them, buy into, which is that the money supply, you can see M here,
Uh-huh.
drives the T, which is volume of transactions, goods and services, right? MV
Uh-huh.
equals PT. That's the quantity theory. I mean, I learned that in my MBA, and almost all economists learn it early on. That is implicit in the Fed's monetary policy, is that if they want to increase economic activity, they increase the money supply, the M.
Right.
That's where it all starts. It's embedded in their minds early in their education, and it's implicit in all the Fed's actions. So then if we go and see, this is the true money supply, and I'll deal with what that is. But here you can see that every time they've constricted the money supply, initially below zero, but then as the debt rose higher and higher in America, and Canada's, by the way, is worse than America's total debt. But it's 340% of GDP in this zone now, but they just have to restrict to below about 5%. And they're into the zone of constricting the money supply enough that it causes a cascading down of the economy with a lag always. But you can see every time since the 70s that the Latin American debt crisis, the SNL crisis, the Mexican peso crisis, dot-com bust, subprime loan crisis, right? Every time. And then you get the recessions. Now, you have to have some duration at the bottom before you trigger a recession. This is quite a sharp in and out, and they continue. But we've got, the debt level now has gotten so high that we are below 5%, and we're into the regime now of major economic correction.
So you're calling this U.S. recession 2.0.
Yeah.
Okay. And the
Great
debt
financial
is bigger.
crisis. Great
Okay.
financial crisis 2.0, yeah.
Okay. All right. And a lot of this also has to do with demand for dollars and liquidity squeezes. And I saw that you were addressing what happened in the repo market, that most people are just trying to brush aside that corporations needed to make big tax payments. And that's why there was dysfunction and rates spiking up. What do you think is really behind it?
Well, it's a, are we going ahead with the whole presentation right now, or is this just a briefing before we go ahead?
No, we're live.
We're live. Okay. Yeah.
I don't do briefings.
Okay. So there is a dollar shortage out there due to the constriction of the money supply.
Okay.
And the constriction in the money supply is global. So let me just go back. I thought we were just doing a briefing there before we were going live. Do you want to just let me just constructively go through this in a structured fashion here? But
you're the captain.
Okay, appreciate that. So the money supply that we just touched on there, the concept of the money supply driving the M here, driving the economic activity, which is the T, the transactions. There's an implicit understanding there of the monetary theorists that as you accelerate the amount of money in the economy, that you accelerate economic activity. Now we have a debt-based money system where every unit of money in circulation starts its life as a loan, and it is a unit of debt. But we've also got leverage of debt in the system. So it turns out if you look at the Fed puts up various aggregates of money, M1, M2, M3, etc. M3 no longer, they canceled it.
Why?
They said to save $500,000 a year.
Why do you think?
It would have exploded during quantitative easing. It would have been uncomfortable to look at.
Okay.
But either way, we don't have it any longer. So I maintain that when you look at money supply in general, that you want to be looking at what's called the true money supply. And the true money supply is simply an aggregate which looks at all checkable deposits, all liquid deposits in bank accounts, pardon me, and then all physical currency in circulation. And we can see here the blue line, the light blue line, moving, and that's the year-over-year growth in the true money stock. The money stock is the money that's out, and the money supply is the year-over-year change in the money that's in the system. And we can see here with the light blue line how it's moved quite radically at times, but you know, in the 15% range is not uncommon after these recessions. So they've increased the amount of money that's available in the economy by 15% per annum as a response, as a reflex to these recessions or slowdowns in the economy.
Wow, 81, 82
Yeah,
was after Volcker.
yeah. They
Yeah,
weren't, I mean, that's post 19% interest rates,
yeah,
right? So there was a real, a tremendous reaction there and a tremendous printing of money, if you want to call it printing of
yeah.
money, although it's digital. But that was the response. So we have a credit-driven economy now, and just to give you a sense of the amount of money we're talking about here, is that the money stock, which is all the money in circulation in on deposit as well as physical currency, is about $14 trillion. All the debt in existence now, and that's the Fed's Z1 flow of funds report, is about 72 trillion. So there's about 5 times more debt in existence extant in the US economy than there is money to pay it off. And as a consequence, what you have then is, with that kind of leverage, is that a constriction in the money supply has a tremendous effect on the actual economy itself and on the debt structure of the economy. And you don't have to constrict it very much. You've got to continually increase this amount of debt outstanding and continue this credit cycle in order to have continued continuance of really the Fed's credit bubble or credit bubble economy that they've blown. I'm just going to zoom in a little bit closer right now to a chart here. And this is from Mises.org, and I put in these posts to Signal, but you can see there the light blue is the what's called the true money supply, and as I mentioned, that's the Rothbard-Salerno measure there. But what they've said is that basically this is just all the money that's available in the economy that's checkable, that's liquid, no holds. Anything with a hold is excluded from it in an account, and then all the physical currency. And you can see there that each time that since 2000 that they've gone below roughly 5% and maintained it there for a period of time, we've had a reaction in terms of a market event and an economic event as well. Now, the most rightward post there says Great Financial Crisis 2. You can see that's where we are now, and this chart ends at January, but the most recent data I've seen are through April, and we're about 3.1%, which is roughly where it is at the lowest point on the right-hand side there.
Okay.
So we're into this now for the money supply was crashed in Q1 2017 was when it showed up, and we're now at the point now where we're about 2.5-2.75 years into this, where we will start to I believe see this constriction in the economy start to hit.
For how long?
Well, that's a very good question. That the problem that we have here is the tremendous amount of debt outstanding with 72 trillion and 340% of GDP. To put it in context, historically, the normal level of debt was about 150% of GDP. That was the equilibrium level that was maintained through the prior century. And we've now run it from 150% of GDP up to 340% of GDP. So we've got in the economy about 200% of GDP of excess debt, if you want to call it that. So there's about $40 trillion of excess debt. So the economic cycle has been converted into a purely debt cycle in the US and Canada and in Europe. And with this constriction of the money supply, the year-over-year change in the money, the addition to the money that's outstanding that maintains the continuous economic cycle through the extension of credit, they're basically bringing down the entire prior decade of recovery post the prior recession there in 09. So back to your question of how long, it's I maintain this will be the strongest economic contraction, perhaps greater or equaling the Great Depression in terms of its consequences. I know it's a very strong thing to say, and a lot of people would recoil from that. But the contraction of the money supply after 7 years of ZIRP, zero interest rate policy, maintaining and increasing the credit dependency of the economy now is going to have a very, very astringent effect on the economy as a whole. You'll have credit collapse and a banking system disruption.
Okay, so even though we're told that U.S. banks have gone through the reforms,
right,
and they're in much better shape, Europe didn't do it, you still see vulnerability in the U.S. financial system, systemic vulnerability.
Yeah, very much. It's all of our economies, Europe, Canada, United States, they all rely on this debt money system, and you've got to maintain the flows of additional debt to continue the economic activity. And when you constrict it, it brings down the debt structure. So when you look at the leverage of the banking system there that we've got, and we've really seen, recently, we've started to see signs. I'm just going to flip over here to the, this is a chart from the Federal Reserve, and this shows the effective funds rate minus the interest rate on excess reserves, the IOER. So that's the spread, and historically, it's been a negative spread, that the effective funds rate has been less than the IOER. And this trend here has been one of the tightening money supply. So you're talking about Q1 2018. So about a year after they first started to constrict the money supply, you started to see the lending. This is really a marker, a demarcator of lending stress between the banks, right? The effective Fed funds rate is a measure of interbank lending in the overnight market.
Right.
So what we're seeing here is, as the interest rate creeps up, and you had a 20 basis point blowout here above zero 2 weeks ago. But as this has continued to creep up, it's indicated greater and greater stress. And that makes sense. If we look at a tightening money supply in a credit-dependent economy, the economy as a whole starts to slow. The performance of the markets start to slow. And we've, standing back far enough, if you look at I like to follow the NYSE composite index, because it's not cherry-picked. It's 2,000 stocks from microcap through to the mega cap. And if you look at that chart, if you stand back, look at a 15-year time frame, you can see how the markets have rolled over. So as these financial markets start to wane in terms of their performance overall, and the economy starts to slow, and we're certainly seeing all kinds of signs of that now, is that the assets start to underperform, and the need for additional credit starts to become quite apparent. Both in the banking sector and in the economy as a whole. And this is what is really driving the demand for money increasing, at the same time, of course, that the banks, as they see these financial events coming, start to hold their capital. They hold it more jealously. They hold it more close to their vests.
So rates go up not because the Fed is tightening, not because of economic growth, but just the competition to roll over debt.
Yeah, well, it's the availability of money, right? The rates are really reflecting the availability of money in the system. And what we're seeing here with the spike in the differential of the Fed funds rate versus the IOER is that the fact that the Fed is losing control of the interest rate signal. The banks are now ignoring the Fed funds rate, or sorry, the bandwidth of the Fed funds rate, and the lenders are holding back their cash, and those who need it are having to bid it up to get a hold of it.
How high can they bid it up in the middle of a crisis? 20%?
Well, I mean, these are what you're seeing.
Look at what happened with LIBOR in the 2008 financial crisis, coach.
Yeah.
And you can get an idea.
So this sparked markedly in 2008, during 2009, during the crisis. But you know, several percent is not impossible. But of course, the Fed steps in with QE and other things. But you know, the problem is that the 2.5 years, and let's go back to this other chart again, is that you've got 2.5 years here of constriction of the money supply, and that embeds economic conditions into the economy, into society as a whole. And simply loosening up money supply doesn't change that on the turn of a dime.
No, that would take another 2 years.
Yeah,
Say the Fed ended QT when? This month? They're supposed to end it?
Yeah.
So it'll take 2 years.
It takes years. It takes years to affect change on the economy. We're already at 340% of GDP. You know, the appetite, in the end, you get credit revulsion in the economy as well, where people are like, you know what, I've had enough debt. This is not good for me. I'm not feeling good about this. But it takes a long time for the economy to turn around. And you can't, once you've tripped the credit cycle into economic and financial contraction, you cannot turn around again with monetary tools. And that's what's really so dangerous about what the Fed is doing here. But you can see from this chart here, there's very cyclical and very precipitous. I mean, they basically tripping into these crises here, they collapse the money supply in effect. They go from, you know, you can see here around just prior to the 2001, they went from 9%, they went down to about 3%. They peaked out at 18% there just after the dot-com bust, but they drop quite precipitously in a relatively short period of time, and then they maintain the tightness, and that's what embeds the conditions in the economy for these financial events and for the economic contractions or recessions that follow.
David, do you think that the monetary system is in danger following the upcoming recession and crisis? I mean, we've had
$60, $70 barrel in the longer
sorry
run.
about that. It's, you know, there's quack. So we've had this system in essence since 1971, when all currencies, you know, changed to simply being fiat currencies. So do you think that perhaps, you know, this can finally lead to a more, you know, prudent and, let's say, better thought of monetary system? Or you think we might make it another business cycle with the existing one, kicking the can down the road another, like, let's say, 5, 6, 7 years? Well,
you never know. The interventions that happen, right? I certainly didn't foresee the quantitative easing in the past cycle, but it's building up now to quite a dangerous level of contraction after what happens when you run zero interest rate policy is that you create an extraordinary credit dependency in the economy where all activity is dependent on additional credit. There's no organic growth to speak of. What the Austrian economists also call as malinvestments. Yes, a complete distortion of the economy and the productive capacity of the economy. And so this type of a constriction after such a prolonged period of credit excess doesn't lead to a very good thing. And there's other
do sovereigns default, David?
Well, there's a hard default and there's a soft default, right?
I don't know the difference.
Well, the hard default is Argentina.
Okay.
And the soft default is
Weimar Republic.
Monetary inflation, exactly.
Okay.
So that's a hard and a soft. So,
or if we want to use synonyms, there is the honest default and the dishonest default.
Yeah.
Because,
So the dollar is really the easiest sacrificial lamb that they have left, right?
Yeah, but I mean, the issue here is the cascading of the economy that happens when you constrict credit in a credit dependent. You have the entire edifice of the credit market becomes disrupted, and we're seeing it in the repo market. We're 2 and something weeks into it. it's interesting. I noted there on Twitter yesterday that the repo market there, that Goldman Sachs' presence in it, and I'm not sure if you're aware, but the treasurer of Goldman Sachs is an advisor to Steve Mnuchin on the whole repo market structure. But when you look at the capital sources for Goldman Sachs, Monday Morning Macro, who is a person that posts on Twitter, very, very good statistical analysis, economic analysis. I posted a request there, and she found Goldman Sachs's exposure to the repo market, and they list their sources of credit in a presentation that they put out in the summer, and about $102 billion of the money that Goldman Sachs uses to invest comes from collateralized loans. And so Goldman Sachs is being directly affected by this repo market contraction. I mean, we saw that the GC, the rates went 8 to 10% on non-treasuries and 4% in the treasury market. So the repo market is a separate market from the interbank market. Any financial institution of size can participate in it. And again, scale, we're talking about a $5 trillion market in total. And what's unique about America is that the repo market, the vast majority of the credit in the repo market is overnight. So what you have there is a 5 trillion market, and let's choose number 80% is rolled every night. And when you have a seizure in that market and an explosion in interest rates, you've got an immediate transmission of high interest rates into the banking system and into the economy. Hmm. So this is why Europe is compared to the States, the preponderance there of the money which is in the repo market there is of weekly and monthly duration. And the U.S. is quite unique in the fact that the market is an overnight market for the vast majority of the funds in there in a $5 trillion market. So if you think about that, everybody talks about treasury issuance being a big issue. Well, in the repo market, you have basically $4 trillion being rolled on a nightly basis. And when you have a problem with the mechanics in that market, with the plumbing in that market, it can be transmitted very rapidly through to the banking system and the economy as a whole.
Okay. So I know that the guy from TF Metals is a long-term gold bull.
Yeah.
If we get into this liquidity crisis, and I don't know, did you ever read a book by Martin Weiss in the 80s called The Great Money Panic?
I didn't.
Okay, and he talks about this, T-bill, right? People to roll over debt, rates spike, people
Mm-hmm.
sell everything,
Mm-hmm.
including the kitchen sink to raise cash.
Mm-hmm.
Do you think that gold, if we first have an honest default,
Mm-hmm.
Suffers before the 2 years of easing and new QE come in to affect the market, and we have that severe inflation? Do we have both? First the deflation and then the debasement?
Yeah. I mean, when you have a credit-based money system, the collapse of the credit system, if it's severe enough, can result in the collapse of the money. So it's, ultimately at an extremis, if you were to use Greenspan's terminology, you end up with a currency rejection. I mean, Greenspan said at extremis, fiat currency is always rejected and gold is always accepted.
Okay.
And I think that is ultimately where you head in this. Now, there's a dollar shortage right now and a dollar panic. But I think there's enough visibility here of the problems that we have coming at us that the Fed is going to try to loosen in some form or another. But I maintain from the Austrian perspective that you've got these embedded distortions in the economy now, and they need to be flushed out. You've run interest rates for too long at too low a rate, and they've embedded into the economy these economic distortions. and they've got to go. And they can't be, once you have a collapse of the let's call it the speculative fervor, or what people call the animal instincts. Once you have a break of that fervor, then psychology, in terms, humans tend to contract in their view, and they just want to consolidate. And that is not what you can have if you want to continue this cycle any further. To continue the cycle, you've got to have credit available in gobs, and you've got to have people that are willing to take it out, and then also to speculate with it. And certainly, I think there's a credit revulsion that's setting in, and I think that the fervor appears to have gone from the markets here, and that there won't be a quick recovery with more loose credit.
Very interesting. Steve, you have anything you want to ask David? You're still here?
Get the
No,
opportunity to
yeah, I'm
meet
still here,
traders
Coach.
all over the world in a demo.
No, as you know, we agree.
Okay. So David, go ahead. You want to show something else?
No, I
Wrap
think,
it.
yeah, I think that these charts basically sum it up, is that you've got this very long history here of contraction in the money supply in the economy, and the consequences. You can see here that the trend is generally an increasing minimum to induce a crisis. It's a time function, so you have to have it reduced for a period of time before the effects set in. A quick down and out again typically does not induce a recession. But we now, we're 2.5 years, 2 3/4 years into this now here. And I think we've got the conditions in place for another recession with incredibly high debt loads and a lot of excess and distortion in the economy. And I think that it leads to a very
Reversion to the mean.
Yeah. To
or more
sustainable.
so. Yeah.
Yeah. So if you're going to see a debt cleansing, we're at 340% of GDP. There's, looking at historical norms, we have about $42 trillion of excess debt in the system.
Huh.
And that debt needs to be purged. Now, what does that do to pension funds?
Yeah.
Right? Because
Everything.
I think that one of the biggest deceptions of this age is people holding on to debt as assets and not fully understanding the consequences of looking upon debt, treasuries, and different types of bonds, and understanding that there is an ultimate end of this distortive credit cycle, and these things can rapidly become the certificates of confiscation as they were in the 70s again.
Yeah. And also a huge burden, and debt is a prison.
Mm-hmm.
We're going to learn it's a prison, aren't we?
It is. It's really it's a form of enslavement. Absolutely.
So, David, what's the best way for people to keep tabs on what you're thinking during this ongoing process that you presented today?
I try to post my things regularly on Twitter.
Okay.
At Real David Jensen.
Okay.
Is the place to see it, and that's kind of my focal point.
I follow you now, buddy.
All right. Excellent.
And I think you're a great follow. So I recommend that everyone that is here watching it live and here's the recording later to, keep your finger on the pulse of what David is saying, even though it, doesn't make you want to go out and do cartwheels. It is something you have to be aware of, because if you want to be a good steward, you have to be on the lookout for financial storms. And what David is saying is kind of seems like a hurricane.
Yeah, and one maybe a final point here is that when you look at this quantity theory of money, which is taught in all the MBA schools and economic schools, is that if we go look at John Law, and he was a Scottish economist who basically accessed France's money supply. They were on a gold money system back in the 1700s, and he became friends with the regent of France, who was running France for a boy. I think it was King Louis XV. Yeah, King Louis XV was a boy. He met the regent who was running the country at a gambling casino. And over time was able to convince the regent that France suffered from an insufficiency of money. And so John Law and the Mississippi Scheme, as it's called, John Law introduced France to paper money, and in 4 years he collapsed the economy. through this creation of money. There was no insufficiency. He was just kidding. But they had a hell of a run for 4 years there.
Yeah.
And so when we look at this history, and I encourage people to read about John Law, and then if we go back to the quantity theory of money. Sorry, I lost the. Yeah, go back to the quantity theory of money again. Embedded in this equation is the concept of a connection between the money supply and the volume of transactions of goods and services, so GDP. So what they're saying here is exactly what John Law was saying in the 1700s. More money, more M, gives you more T. So more money, which in a debt-based money system is more debt. So everybody's excited now about the fact they're going to lower rates. What does lower rates mean? It means more debt. People take out more debt, more money.
Yeah, and John Law really needed a haircut.
He did.
So we're going to get one. And you know what? I want to thank Scott Henderson, who scours Twitter for talent. And he retweeted something by you. And that's why I was able to find you and have you here today. And
Okay.
it was very enlightening. And we're getting comments of it being an excellent interview. So really great to meet you, like it or not.
My pleasure.
You're my trading warrior brother now, buddy.
Excellent. And thank you to Scott.
Okay, and let's keep in touch and do this again as things progress into the abyss.
Excellent. And thanks to Steve. Is it your partner there, Steve?
Yeah, Steve Volge.
Thank you for being with us. Unfortunately,
Okay. It was my pleasure.
People don't want to hear unpleasant truths. They would rather hear, pleasant lies and promises.
Yes.
Well, forewarned is forearmed, right?
I'm sticking my head back in the sand after we end this. Okay.
Buy some gold.
All right. Okay. We're doing it, buddy. Thank you so much.
My pleasure.
All right.
Cheers.
Bye-bye.
All right. So that's a wrap, everyone. I hope you enjoyed the interview. And here's so you can find David Jensen at Real David Jensen. And he was as real as it gets, like it or not. So that's a wrap, everyone. I want to thank everyone that joined and took advantage of our promotion, and our family grew quite a bit. And have a great weekend, everyone. Remember, don't just count your pips, count your blessings. And Steve and I and the whole team will be back with you Monday. So adios. Thank you, Steve. Thank you, Face.
Thank you, Coach.
Thank you, team. Adios.
Thank you.
Thank you, David.
My pleasure.